The stock market traded with a mixed tone on this week as the investor weighed interest rate expectations, upcoming economic data, and corporate earnings. The US equities slipped across the major benchmarks, while the Canada posted modest losses, and the Latin America also diverged with few losses, with Brazil showing resilience even as the Mexico and the Chile retreated. Also on the Wall Street, the downtown was broad based, but the relatively mild outlook was low. Also, the Dow Jones Industrial Average fell 171 points or 0.37% to close at 45,600. Also, the S&P 500, widely regarded as the best barometer of the US markets, lost up to 18 points to finishing at 6,500. Also, the tech-heavy names, that is the selling pressures at the Nasdaq Composite, also declined 75 points, also to reach at 22,400. Also, the small cap stocks were hit harder even more, with the Russell 2000 sliding 0.92% to reaching 2,350. Also, interestingly, despite the declines, the investor nerves appeared steady as the CBOE volatility index, that is the VIX index, also slipped 2% to now reach on 16, suggesting that the traders view the pullback as the profit taking rather than a deeper sell off. Also, in the Canada, the equities mirrored the US trend, but with the softer losses. The S&P TSX Composite Index also dropped 56 points to reach at 29,700, while the S&P TSX 60 also edged down 0.1% to finish at 1,700. Also, the energy and the financial stock dragged on the performances as the investors tracked the oil prices movements and global demand outlooks. Elsewhere in the Americas, the market presented a mixed picture. Brazil Bovespa managed to buck the trend, inching higher by 66 points to reaching 146,000, and the gains in the commodity-linked sectors helping offset the global risk-off sentiments. In contrast, Chile's S&P IPSA fell 32 points or 0.3% to reach 9,000, while the Mexico's S&P BMV IPC suffered one of the sharper declines in the region, sinking 462 points. Also, the divergence underscored how the country-specific factors from the industrial performance to the consumer demand continues to shape the market direction. Overall, the trading across the region was also marked by caution. The investors are awaiting the key US economic reports on the inflation and job rates, which also could heavily influence the Federal Reserve monetary policy path. With the indices still near record highs, even the slightest surprise in the economic data could swing the market sentiments quickly. The analyst noted that the recent pullbacks are likely part of a natural pause following strong gains in the recent weeks rather than a shift towards prolonged weaknesses. Looking ahead, the global markets will continue to react to the central bank policies and signals, corporate earnings, and macroeconomic data. For now, the volatility remains muted, suggesting that the investors are not rushing to unwind positions but are also instead adjusting portfolios carefully in anticipation of the next market moving catalyst. The commodity markets also traded mixed on the week range, with the 52-week range coming very low, with the energy prices mostly lower, the metals showing slight weakness, and the agriculture products edging higher. The gold is at the very record highs. The geopolitical considerations are at the peak, and the currency movement, while keeping an eye on the broader economic outlook, also continues to influence the raw material demand. Let's talk about the energy markets. The crude oil prices slipped as investors reassessed the global demand prospect. WTI to settle at $64 per barrel, trading within the 56 range. Also, the Brent crude oil coming down to $68.2 per barrel compared to its yearly range of $58, Analysts also attributed the mild pullbacks to concern about slowing demand growth, particularly in the major consuming economies, although the supply discipline from the OPEC countries provided some support. The natural gas also rising that to level $3.5 per million BTU, with the prices moving between $2 around, and the stronger seasonal demand and tightening inventories gave the contract a modest boost. The precious metals also traded with little conviction as the investors awaited further signals from the central bank. The gold futures were virtually flat, dipping to nearly $3,700 and holding near the upper end of 52-week range. Also, the market's participants said that the metals is complex market and it is consolidating after sharp gains, with the safe haven demand steady but tempered by the strength in the United States dollar. The agriculture commodities were also mixed but generally firmer. Soybean rose to $1.5 to now reach $10 per bushel, supported by the steady export demand and concerns about the weather pattern. Also, the prices remain within the relative tight 52-week band of $9 to $10. Traders noted that while the fundamentals are stable, the soybean continue to be sensitive to the development in the global trade flows and the climate forecast. Overall, the commodities landscape reflected a cautious tone, with the energy traders monitoring demand uncertainty, metal investors taking a wait-and-see approach, and the monetary policy and the agriculture market stabilizing on the supply front. Also, the fluctuation is high, also in the particular inflation data, which is also high and also likely going to play a decisive role in shaping prices momentum across the complex.